So today we're going to talk about how to earn money using Bybit funding fee arbitrage. So the cryptocurrency perpetual contract market has launched a funding fee mechanism in order to anchor the contract price to the spot price. According to this mechanism, if the market is bullish and the long side prevails, the price of the perpetual contract will be higher than the spot, and the funding fee will be positive. Conversely, the short side will pay the multiple sides. The specific rules are summarized as follows. When the funding rate is positive, multi-users, that is contract buyers, pay the funding fee to the spot side, that is contract sellers. When the funding rate is negative, the opposite occurs. So how does Bybit funding fee arbitrage work? So funding rate arbitrage is a value-neutral hedging strategy that allows a trader to take a position in the spot market against the same pair as the contract market, thus achieving a hedging effect. Any losses due to price movements in the contract market are offset by gains in the spot market, and vice versa, allowing traders to earn capital fees without closing their positions. According to this feature, it is possible in theory to achieve high returns if you hold positions corresponding to those coins whose funding fees are consistently high, without considering the risk of coin price fluctuations. In other words, if the funding rate of a currency is very high and the rate is maintained for a long period of time, investors have the opportunity to keep gaining via the funding rate mechanism. On Bybit, platform funding fees are settled every 8 hours at 12 UTC, 8 AM UTC, and 4 PM UTC respectively. For example, let's take the Luna 2 perpetual contract as an example. According to the historical data of the Bybit perpetual contract funding rate, the contract funding rate has been positive and in the high end for a long time. Theoretically, this means the user can receive funding fee income as long as they hold a short position. However, it should be noted that the above revenue strategy doesn't take into account the risk of coin price fluctuations. All those investors can receive the capital fee gain as long as they hold a short position in Luna 2. That's a buy down. If the market moves against the expectation as the price of Luna rises, the current position faces a loss. So in order to hedge the risk, investors need to buy the equivalent Luna 2 spot or hold equivalent Luna 2 holding Luna 2 long position in the margin market. So mastering the capital rate arbitrage strategy. So in order to master the funding rate arbitrage strategy, you will want to focus on these two aspects. 1. Currency selection, high funding rates plus long duration. When selecting your currency, choose those with a very high funding rates that are sustainable as well. Note, before adopting the funding rate arbitrage strategy, you can check the funding rates of all contract currencies through Bybit funding rate, real-time, and historical data. Use both spot and margin markets to take two-way positions in order to hedge against the risk of currency price fluctuations. In order to cope with the risk caused by fluctuation of the currency price, when you take a position in a perpetual contract of a capital rate arbitrage strategy, you need to hedge the same position with spot or margin in order to achieve long-term profitability. So using the capital rate arbitrage strategy on Bybit, so 1, the money rate or the spot arbitrage on perpetual contract. So buy the currency spot, simultaneously open a short order for the same position in the corresponding currency perpetual contract. According to the profit target, choose the short position of the perpetual contract at the right time, and sell the spot to earn profit. Example, assuming the current BTC price is 20,000 USDT, the funding rate is 0.03%, use 2,000 USDT for funding rate arbitrage. So 1x margin, buy 1000 USDT by BTC spot and short 1000 USDT BTC perpetual contract. So assuming equal funding rates every 8 hours, you receive 1000 USDT times 0.03% equals to 0.30 USDT every 8 hours. So receive 0.30 times 3 is equal to 0.90 USDT per day annualized rate of return. 0.90 times 365 divided by 1000 equals to 32.95%. 3x margin, buy 1500 USDT BTC spot and short 500 USDT BTC perpetual contract. Assuming equal funding rates, receive 1500 USDT times 0.03% equals to 0.45 USDT every 8 hours. So receive 0.45 times 3 equals to 1.35 USDT per day annualized rate of return. 1.35 times 265 divided by 1000 equals 49.275%. So note, the hedging value should be equal to ensure that the hedge is achieved. In a nutshell, you can create a position in the same value and opposite direction in the spot margin and perpetual contract markets respectively. Perpetual contract funding rate with margin arbitrage. Given that margin transactions involve margin interest rates on both currencies, users need to consider the potential impact of margin rates when adopting a funding rate arbitrage strategy. When the funding rate is positive and the funding rate is greater than the margin rate plus commission rate, the short side of the contract can charge alongside a funding fee. That is, the perpetual contract is open short and margin to buy a position of comparable spot value. So B, when the funding rate is negative and funding rate is less than margin rate plus commission rate, the long side of the contract can charge the short side a funding fee. The perpetual contract opens long and margins open a sell of comparable value on the spot. Overall, considering the transaction cost, here's what the size of arbitrage space between the perpetual contract and spot margin trade is derived from. So the difference between the perpetual contract funding rate, which is the floating rate, and the fixed rate. So Bybit adopts a tier rate system. The higher the account level, the lower the transaction fee rate and lending rate. Users can refer to the rate system to develop a reasonable funding rate arbitrage strategy to obtain higher returns. Okay, so this is the margin data. So final word. So 4 important things. So 1, reduce margin levels to prevent your position from blowing up due to abnormal price fluctuations. Although capital rate arbitrage can be low risk or even risk free based on the convergence of perpetual contracts and spot prices, it's necessary to remain cautious. Do your research and choose your currency carefully. If you want to profit from the funding rate strategy, you will need to do thorough research on the relevant currencies and details of the funding rate. Try to choose currencies with high rates and long durations. 3. Invest a reasonable amount of capital in order to limit your trading risk. As small cap currencies may not have enough market depth, investing large amounts of money in them may produce high levels of slippage. In order to avoid high transaction fees from high frequency position transfer and currency hedging, avoid frequent trading between coins, which may make it difficult to turn a profit.